This is the Cryptonomics Podcast, telling you why cryptocurrencies are the kryptonite to the traditional banking and credit systems. Learn how to store, manage, and spend your wealth in the cryptoverse. Listen about Bitcoin, Ethereum, and decentralized finance, and hear from our successful crypto investors and miners about their strategies. Whatever you're interested in learning about, Cryptonomics is your one-stop shop to everything crypto. Now, here is your host, Ty.
Hey CJ, welcome back for episode 4 of the Cryptonomics Podcast. We got a fun episode in store, a little bit shorter than normal, so we're excited for that new format. But let's go ahead and get into it. So I'm not gonna lie, I've been spending a lot of time on the new social media app called Clubhouse, listening to a bunch of crypto conversations, Bitcoin conversations, stock market conversations. And something that keeps coming up that I don't seem to understand fully just yet is the layers of blockchain from layer 0. I believe it goes up to layer 3. So I was hoping that you could kind of educate myself and the audience on exactly what each layer represents, and kind of the use case for each one. So without further ado, I'm going to hand the mic over to you, and you just go ahead and you just let us know and get us all educated.
Sounds good. Well, yeah, so there are 4 layers to the blockchain. There's layer 0, 1, 2, and 3. And I think, trying to paint a picture here of what we're trying to describe is when somebody looks at an application like Venmo, the basic user of Venmo is saying to themselves, oh yeah, I download the app and I send money to a friend. It's that easy. And honestly, that's really all you need to know. But for those who like to dig a little bit deeper, they start to figure out, oh, well, you got to register your bank account. You got to deposit funds. You got to go through identity verifications. There's all these additional steps that become obligatory because of what's done in the background to actually use that Venmo app to complete that easy process of just sending funds from one person to another. So when we talk about the layers of blockchain, it's just going a little bit deeper into the technology itself. So layer 0 of the blockchain, and it could be any blockchain. All blockchains can be broken down into layer 0, 1, 2, and 3. So it's not like, Ethereum is a layer 1 and Bitcoin is a layer 0. No. All blockchains have layers 0 through 3. And layer 0 is really the infrastructure, the foundation. So for cryptocurrencies, it's the bridge really from the internet to the blockchain itself. The existence and storage of that data on the internet maintained in the real physical world by miners who are setting up their mining farms and maintaining the transactions, processing the transactions, maintaining the security and integrity of the Bitcoin blockchain itself. So layer 0 is like the layer that is unseen and unknown, but is of fundamental importance to the overall blockchain itself. Layer 1 is really like when someone talks about the app. Hey, have you downloaded Venmo? That's like layer 1 of Bitcoin. Hey, do you know about Bitcoin? If you're talking about the network, you're talking about the actual blockchain itself. This is the layer 1 concept of Bitcoin, and that is where all that information and data is stored on the internet, and where it's accessible with block explorers, where you can copy and paste your address, check the amounts that have been sent, trace transactions, things like that. Layer 2 now is where the fun really starts to begin, because that's where you get to start to build upgrades to that layer 1 chain. That broad basic functionality of the blockchain on layer 1 is built upon even further in layer 2. And an example of what you could build on layer 2 for Bitcoin would be like the Lightning Network. Lightning Network is a layer 2 to the layer 1 of Bitcoin's settlement network. And for Ethereum, the level 2 for Ethereum would be like smart contracts. So smart contracts are built on level 2 for the foundation of the level 1 Ethereum blockchain. You can
Good
use.
question. So, would it be fair to say that layer one is kind of like the architecture and layer two is kind of like applications?
Yeah, yeah. In a way, yes. I would think that layer two is actually like the application architecture, and
Okay.
then as we get into layer three, that is more of the application
Like
layer.
user interface.
Yeah, those are going to be layer three. That's exactly right. Might as well just go right into it. Layer three is the user interface, the easy, hey, have you downloaded Venmo? Hey, have you downloaded Lightning Network? Once that's built out in a layer three application, that will be the easy user interface to then interact with the complex architecture built on layer two, which is then settled on layer one and maintained by layer zero.
Okay, no, yeah, that makes a lot of sense. So layer zero is the inception of the blockchain. Layer one is the architecture of the network. Layer two is the architecture of the apps. And layer three is the user interface of the apps.
That's right.
Okay, that's like way easier to understand than I expected, to be honest.
A lot of people try to make it more difficult than it needs to be. And I want to thank everybody out there who's listening to us for your feedback. Sometimes I go off on tangents, and some of the best feedback we got was, hey, we're all beginners and we want to learn. So let's just take it step by step and keep it simple. So this was a great little message for us to get out there, just simply explaining, layer zero, layer one, layer two, layer three. You have all these layers within any blockchain that you're going to invest in. And, if you're going to do your due diligence, you better be sure that layer zero is there. That infrastructure to the real world that gaps the physical world mining infrastructure so that the blockchain can exist on the internet has to be strong, and it should be growing. And when it comes to Bitcoin, that is the strongest it's ever been, and it's growing at a rate that the fastest it's ever been. And then layer one itself basically would be the settlement layer, and that is the integrity of the blockchain. So number one, do we have the foundations? Do we have the miners and the infrastructure? Yes, we do. Layer one, do we have the security and trust being delivered by that layer zero? And when it comes to Bitcoin, yes, we absolutely do. Bitcoin has had over a 99.9% uptime in its history. It's only been down twice in its entire history, and it was for very limited amounts of hours. Some news that went around the other day is that the Federal Reserve Network went down. And at the same time, Janet Yellen is saying how Bitcoin is, can't be relied upon. Yet Bitcoin has 99% uptime, and the Fed network's failed more than Bitcoin has. So they're failing at their own layer zero level.
It was kind of funny how, like, immediately after she said that, the Fed's network was down. It was like karma was hitting her in the face, like, instantly.
Don't mess with coders.
Don't mess with Bitcoin. Just accept it. It's here. It's not going away.
We built your world, Miss Yellen. Everything you use, everything you hold in your hand, we built for you. So be careful what you say, Mrs.
Yeah, no, absolutely. Yeah, no, I think that's a good overview of the layers of blockchain. Like, I mean, I totally understand what you're saying about like the use case of each layer. So when you say settlement for layer one, like explain what like settlement means.
Yeah, so just the security and trust of a transaction once it's processed. So with Bitcoin, we know once we have one confirmation, that's all we need. If you're using exchanges out there, you might realize that if you deposit Bitcoin, some exchanges require only one or two confirmations before your deposits are cleared for trading. But if you deposit Ethereum or some far out there blockchain, shitcoin, it could take up to like 500 confirmations. And that's just because that layer one settlement isn't guaranteed until the chain has become long enough in order for the economic incentive to hack that and reverse that transaction, is in favor of the chain itself. So Bitcoin delivers the highest level of security and trust, and that's exemplified by its layer one settlement.
Gotcha. Okay, no, crystal clear. So I guess kind of transitioning into the next like question that I hear a lot, especially on Clubhouse. There's always a lot of questions around wallets, how to store, where to store, why to use certain kind of wallets. Do you think you could explain the difference between cold storage and hot storage, and just maybe like your personal regimen and how you store your coins, and why you do that?
Yeah, absolutely. So wallets are something that a lot of people like to avoid talking about. It's because right now in cryptocurrency, wallets are the biggest risk, right? One of the biggest uh, problems that institutions had getting into cryptocurrency was finding a custodian. And these qualified custodians need to understand the different types of wallets and the different types of security that come with each wallet. So, I think for most people out there who are just starting in cryptocurrency, a lot of times they'll download what is called like a hot wallet, which is basically just like a software wallet. You download it on your computer. It gives you a seed phrase, and if you lose it, you lose it. It's basically just like a starter's wallet.
What would
And
an example of a hot wallet be?
just like something like you went on to MetaMask and you just download a wallet and create an account. So if someone hacks your MetaMask, they'll be able to take all your coins. Whereas if you download MetaMask, but then you take like a Ledger device or a Trezor and connect the Ledger and Trezor through MetaMask, then even if your MetaMask is hacked, they're not going to be able to get your coins because they would actually need to physically sign the transaction with your physical device. So, as wallets are being developed, it becomes more and more safe. But no doubt, wallets are the biggest risk. And a lot of projects have a hard time integrating with these wallets. Like Trezor has a proprietary code. So you need to talk with them before you can integrate your project into their wallet. At least Ledger is open source. So if you're building something, you can get that code and you can integrate into Ledger with your project, which has almost become like necessary at this point if you want to be able to attract a lot of liquidity, because again, it's about keeping it simple. And these what they call hardware wallets, which are like the Ledger and the Trezor. And I do recommend the Ledger. I have multiple Ledger Nano S's. I think that here we come back to this thing again. Keep it simple. The new Ledger has like the touch screen and all this. It just looks like it's not going to last. My Nano S has 2 buttons on it. It feels like it's going to last forever. And even if it didn't, you still get your seed phrase. So if you lose your Ledger, remember your coins are not held on your actual wallet. Your coins stay on the blockchain. Your Ledger just has your keys to access the coins and to sign transactions, or in other words, spend that coin from one wallet to another wallet. So
these hardware wallets, like Trezor, like the Ledger, those would be considered cold wallets or cold storage?
No, because a cold storage wallet is something like where you generate your own seed phrase and then you write it on a piece of paper and then that's it. So, the only way to gain access to those coins is to recover those coins, sweep the keys with your seed phrase and move them somewhere else. That's like long-term. I would assume that whoever the custodian is for MicroStrategy, because they know Michael Saylor is saying, hey, the majority of these coins I'm going to be holding for over 100 years. My company will never let go of these coins. If we need money, we'll just borrow against it. So, they're probably using a cold storage wallet as a solution for long-term holding. But if you want to be able to move your coins back and forth, which most people like to be able to trade, they'd like to be able to try to, for some reason, they think they can outperform the market and they got to sell high and buy low because they got to outperform the best performing asset class in the world. I don't know how many people actually end up winning who try using that strategy. But the fact of the matter is that people do that. And in order to do that, you're not going to want to sweep your keys with a seed phrase every time you want to sell your coins. So, the perfect middleman from a hot wallet and a cold wallet is the hardware wallet. right? The hot wallet being a simple download of software where your computer can just be hacked and it be taken from you. And a cold wallet being that even if your computer was hacked, it couldn't be taken from you because they need that physical seed phrase outside of the system. Now we have these hardware wallets where it takes the best of both worlds. Sure, use this hot wallet in combination with your hardware wallet, and you'll be able to easily sign a transaction with your keys from something outside the system. Kind of like two-factor authentication, right? When you sign in, it's not about just typing your password. It's about looking at your phone and getting your code and typing in your code as well. There's a second factor to gaining access. And that's what the hardware wallets do. They take the hot wallets, and instead of using the cold wallet method, because they want to be active in the market, they'll take that hardware wallet and they'll say, here's my second source of authentication. I'll store my keys on here. And when I physically approve it from here, then this hot wallet, this software wallet, can go ahead and initiate that transaction. Whereas in the beginning of crypto, you would just download something on your computer, someone would hack your password, or someone would just brute force their way in to your wallet, and then boom, they don't need you to press something on your hardware wallet. They can just initiate the transaction. So wallets are the biggest risk in cryptocurrency right now, but things are moving forward.
So hardware wallets like Trezor, like Ledger, they're kind of, they have the security of a cold storage because they have the seed phrases that only you control, that you can, the only way to really hack it would be to have that seed phrase. But then they also have the accessibility of a hot wallet because you can use it to transfer your funds from exchange to exchange. You can, send it right back to your Trezor or Ledger. It gives you like full access to use them in a trading manner, like you were saying. Is that correct?
That's right. Yeah, that's a really good summary. And, I think the smartest Bitcoiners who understand the technology and understand some of the risks there may be in the future for those who have significant coins, you can write down your seed phrase and you can memorize it and you can throw that piece of paper away. And unless there's some kind of technology that can read your brain, even if the thought's not active in your mind, nobody's ever going to be able to access those coins. And if you have
that's like 24 words in a row you have to memorize. And if you get it wrong, you could be kind of screwed.
Yeah, absolutely. You've seen the stories out there of guys who have misplaced the password or something like that, and they've lost hundreds of millions of dollars in Bitcoin because they don't remember the seed phrase or anything. But 24 words is not that hard to remember if what you're remembering is $100 million.
So in terms of best practices for these seed phrases, what I did is my Trezor came with this little card that you would write every word on. And then I just took the card and I threw it in a safe, and it's in the safe. I never look at it. I never touch it, but I know it's safe there. Is that like a best practice, would you say?
Well, I think they actually should have gave you 2 cards.
Yeah, they gave me 2 cards and I actually filled them both out.
Okay. So yeah, the best practice would be to fill out both cards and give the other card to a trusted confidant. Just in case what if you have a fire and maybe you have a fireproof safe, but you don't get to the safe in time and that stuff burns up. You don't want to have both of those things in the same place. So find somebody that you really trust. And it doesn't even have to be someone who's knowledgeable. It's just someone that you trust, and you let them hold that for you.
Someone responsible.
Yeah, someone responsible.
Yeah. Okay, that makes sense.
Yeah.
And you said you do like the Ledger more than you like Trezor, huh?
I do, and that's because the Ledger has an open source code, so that developers can do what they need to do, so that the cryptocurrency that they're designing can be held on the Ledger. Whereas with the Trezor, you have to work with the Trezor team in order to develop a compatible wallet. So with the pace at which the DeFi markets are being developed and these new protocols are popping up, it's just, I don't want to keep, no one should want to keep their cryptocurrency on a hot wallet. If you are currently holding your cryptocurrency in a hot wallet, you should strongly consider the investment in at least a hardware wallet. I'm not saying you have to, create a cold wallet and start to memorize all these things, but like you said, go to the middle ground and get yourself a hardware wallet where at least there's that second factor of you having to control that wallet in order to send your coins.
No, yeah, no, that was the advice you gave me when I first started off, and I'm really glad you did. And the initial setup of Trezor wasn't like the easiest, but now that I have it set up, it's like clockwork. It's so easy. So I guess the next question I have is, can you explain I don't know if liability is the right word, but the risk of like keeping your coins on an exchange?
Yeah, absolutely. This is something I get asked all the time. So that's actually a really good question. And people aren't really getting it. So let me just say what everybody says. Not your keys, not your coins. It's that simple. When you keep your coins on an exchange, they're just typing in a number on the screen for you to see that says how many coins you have. You don't actually have, they're not giving you a key that you can use to sign. They're just telling you, hey, you have a claim to X amount of Bitcoin on the exchange. So if something were to happen to that exchange, if they were using a hot wallet, or they lost their cold wallet seed phrase, or even someone stole their hardware wallet and was trying to brute force attack, your coins would be at risk because they're held in that wallet. They're not held in your little individual accounts. That's not how it works. It's the coins are held in aggregate in a single. Some of them are in hot wallets. Some of them are in hardware wallets. Some of them are in cold wallet storage. So exchanges need to have that liquidity there in order to actively facilitate the exchange. So some of those coins are at risk. And that's why these cryptocurrency exchanges get hacked, because it's impossible for them to keep everything in cold storage, or else their order books would be empty. So they have to have a liquidity there to facilitate that exchange. And that's the risk of when you keep it on an exchange. Whereas like what you did, getting the Trezor, and then hopefully you get yourself a ledger as well, you'll have 2 Swiss bank accounts in your pocket. When those coins are on your Trezor or on your ledger, you have nothing to worry about. Even if you lose your Trezor or your ledger, remember, the coins are not on the Trezor or the ledger themselves. The coins are on the blockchain. So if you lose it, buy another one as quickly as you can and use your seed phrase to sweep your coins into your new device, so that those coins are now controlled by the keys on your new device instead of the keys on your old device. Because if you do, just like your cell phone, if you lost your cell phone and somebody knew your login to your account, they could easily just open up Google Authenticator, look at your code, and type it in. So it didn't matter that there were 2 factors, because they had possession of both. So there is still a risk when you have that ledger and that Trezor in your pocket, but it's way less than if you're just using a hot wallet, or if you're leaving it on an exchange and they have it in a hot wallet, because it's providing liquidity to facilitate the market.
So just kind of painting out like a black swan event right now. Like, let's say Coinbase ran out of liquidity of Bitcoin because Michael Saylor bought every Bitcoin. And you had your Bitcoin on Coinbase in their wallet. You wouldn't be able to withdraw it because they don't have the liquidity to provide it to you, correct?
That's absolutely right. It's just that when these exchanges, these centralized exchanges, it's just a form of an accounting. That's all it is. When you send Bitcoin to your deposit address on Coinbase, that deposit address is registered to your account, so that when it's received, Coinbase knows to credit your account, but it's not held in that address. Go on to a blockchain explorer and paste your deposit address, and look what happens when you deposit your coins into an address. Those coins do not stay there. They eventually are moved to another spot, either to a liquidity pool or to cold storage. So if it's in a liquidity pool, it's going to be in a hot wallet. And if it's in cold storage, then it's going to be stored. But that's up to the broker themselves. That's up to the exchange themselves where they're going to store it, because you're depositing with them. You're giving them control of your coin. And then they're just typing into their computer, oh yeah, you have one, there you go. So that claim on your one Bitcoin is only good if they're able to deliver on that claim. And if their hot wallet gets hacked or they lose their seed phrase in their cold wallet, then they have no coins to give you and your claim is no good. That's where the saying comes from, not your keys, not your coin. Whereas
it's ironic because, blockchain was kind of invented because of it's decentralized. Like there's no centralized entity that controls anything except for yourself. But when you trust Coinbase or Gemini or, Kraken, you're kind of going against the entire mindset of blockchain because you're keeping the valuable item in a centralized entity.
Yeah, that's absolutely right. It goes against the entire ethos of the system. The whole point is to be your own bank. The whole point is to not have to trust anybody else. So when, for me, at this point in my life, I'm completely out of the traditional system. So, my cash flows go from crypto into the traditional, whereas most people right now have their cash flows going from the traditional into the crypto. So as you're going from the traditional into the crypto, one thing you want to focus on is using the exchange for what it's meant to be used for, which is to exchange, right? None of these exchanges are coming out and saying, buy your Bitcoin with us and store it with us, right? Now, so we're starting to see some of that.
Well, yeah, I was going to say they're doing earn now, which is
yeah, they're doing the earns, but those are more of the brokers, right? Like the Nexo, the BlockFi, the Celsius, because you're giving them your Bitcoin and then they're going out and they're earning with it. And then they're sharing that profit with you in the form of interest.
Yeah, a whole 6%.
Yeah, well, I mean, again, most people, we talked about DeFi and for a lot of people, probably the smartest move is to just go ahead and let a broker like Nexo go ahead and arbitrage the market for you because you're just not going to have the technical skills and understanding to successfully perform the tasks that they're performing. Number one, because the technology is so new. Number two, because mistakes are not forgiven, right? One mistake and you're done. So there's no room for error. You either know what you're doing or you're losing money. And number three, there's a lot of movement. This is like we talked about. You be your own banker means you're a banker. Be your own broker means that you're a broker. And we're not going to be able to do a lot of those things when we have to spend our time and energy, working a job, supporting our families, trying to get ahead in life. So when you're investing in cryptocurrency, trying to get that first foot forward and trying to get to that financial freedom, use the exchange for what it's meant for, which is to exchange your worthless paper money. Just be happy that those little pieces of paper that have numbers on them are still buying you crypto, and use the exchange to buy crypto and then store that crypto in your own hardware wallet where you control your keys, where you are in control of your coins, and you don't have to ask any exchange for permission. If you want to withdraw your coin, if you want to send it, if you want to spend it, you want to exchange it, all you have to do is look in the mirror and ask yourself, can I do this? Is this what I want to do? And when you say yes, pull out your second factor, authenticate, and boom, exchange is made.
I've noticed that if I send crypto from an exchange somewhere, it takes a lot longer for those confirmations to happen than when I send it from my Trezor somewhere. Is that like just...
That's probably because when you send it from the Trezor, you're probably paying higher than average gas costs or fees. If you're using Bitcoin, you're probably paying more Satoshis per byte than when an exchange sends it. An exchange is going to charge you a withdrawal amount, and their job, that person who's sitting there, whose job it is to distribute those withdrawals, is to arbitrage that withdrawal amount. So you'll notice on, sometimes they'll charge you, let's say they charge you $4 to withdraw. Well, their job is to withdraw it for less than $4. So they're going to enter a transaction where they try to make as much as they can off of that fee. It's all about profit maximization in cryptocurrency. And that's one of the ways the exchanges do it. You'll notice that not that long ago, to withdraw your Ethereum from Coinbase basically was free. It wasn't until recently where they're like, we're losing so much money. We got to start charging people for this. And now it's like, well, people don't care about paying for it because they know it costs money. So let's charge them a little bit more and scrape a little bit off the top for ourselves.
Yeah, no.
Which, when you have your own wallet, you don't have to worry about that. You know, if you're trying to send an ERC20 token like Aave from Coinbase to your wallet, and the network is at an average demand, then it might cost you like, you know, $10-15 to send that coin from Coinbase. But if you send it yourself, it'll probably only cost you like $7 to $9. So you know, the costs are reduced when you're your own custodian, because you're not paying for those services. Nobody's going to do anything for you for free. Nobody is going to do that.
Something, yeah.
If somebody's doing something for you for free, you should take a deep breath and ask, why are they doing this? What are they?
Robinhood.
Yeah. What am I getting out of this situation? You know, how are they benefiting from this situation? How are they valued at $77 billion? Is it because they're doing stuff for people for free? And you know, if you think the answer to that question is yes, then crypto's not for you.
Yeah. One last question that was actually asked by an audience member, and I wanted to make sure we asked it on this podcast. And it's kind of not relevant to what we were just talking about, but within a community that we actually met each other in, me and you, you know, you've been really good about calling out some altcoins really early before they kind of blew up. So what exactly do you evaluate when you are evaluating an altcoin as a potential investment? Like, what are the things that you're looking at, and you know, what are some critical success factors that you found, you know, during the due diligence and, you know, into your initial investment strategy?
Yeah. So number one is just experience. I mean, anybody out there knows that whatever job you're working right now, when the new guy comes on the job, you already know what he's not going to be able to do. Because when you first came on the job, you knew what you had to learn and what you weren't able to do. So I've been active in DeFi since 2018, when it really first started, and there was less than $1 billion locked up in these protocols, and not even as an investor. You know, I wish I was fully invested at that time. Everybody's just goofing around with it. You know, is this stuff going to work? You know, is this feasible? We didn't see it turn into what it really is today as fast as it has. But I think that question you asked at the perfect time, because it's exactly what we started this podcast with, which is the layer 0 through layer 3. You have to break down the blockchain through each layer and see whether or not it's feasible, and whether or not what you're going to invest into is already built, has to be built, or is already working and already generating fees. Because a lot of these protocols like Aave are already generating cash flows. They're already generating fees. You can calculate their price to earnings ratio. And the way you do that is by saying, okay, you know what? Layer 0, Aave, it's built on the Ethereum network. I know the Ethereum network is one of the most largest mining networks in the world. It has a strong multi-billion-dollar infrastructure. Check mark next to layer 0. Layer 1, the settlement. Ethereum, it's decentralized. It has a good framework. There are some questions when it comes to tokenomics, like what is is there a finite supply of Ethereum? What is that finite supply going to be? With ETH 2.0 upgrade, are they going to allow inflation to be part of the ecosystem? So there are some tokenomics questions, but can I trust that when I sign a smart contract or when I sign a transaction, that after 20 confirmations, I don't have anything to worry about? Yeah, I'm going to be fine. Okay, check mark. Layer 2. Okay, Aave, layer 2 smart contracts are going to be built. And are they usable? Can these contracts be executed? Are they efficient? Do these contracts cost an exorbitant amount of gas to execute? Or am I going to be able to use these contracts on a steady basis to earn income? Okay, these contracts are strong. They've been audited. They're usable, and I can earn income with them. Check mark. Layer 3, are there any outward-facing applications that are going to help onboard the people who don't understand layer 0 through layer 2? Is there going to be an Aave app in the future that connects to your bank account where you can simply deposit in through your app and then start earning through a automated market making liquidity pool? And right now the answer is no, but you can definitely see the potential for attaching your bank account to a decentralized protocol, and then in the future having that earn interest for you. So check mark layer 3.
Layer 3 part that you just touched on, is that kind of like what a DEX or a decentralized exchange would do?
No, a decentralized exchange would still be a layer 2, because what it is it's in the background, it's a smart contract.
So I think, what's an example of a layer 3 right now?
Probably like when you go to Uniswap and you go on the internet and you go to the Uniswap app and you use the Web3 app, that's probably the closest thing there is to a layer 3, because that's the user side. You're coming with your wallet, you're going to connect your wallet, and you're going to exchange some of the Ether you have on your wallet for another token. You're going to confirm that transaction, and then in the layer 2, the smart contracts are going to execute that transaction, and on layer 1, it's going to settle that transaction, and then layer 2, the miners are going to record that transaction and lock it in.
Okay, yeah, no, that makes total sense. CJ, thanks for hopping back on today for episode 4, Cryptonomics. We're excited, to bring you another episode soon. And make sure you like and subscribe. And if you have any questions, make sure to reach out and ask us. And we hope everyone has a great day, a great week, and we'll see you next week for episode 5.
See you guys. Take it easy.